we want to welcome you all to the April Directed IRA webinar, how to get a loan to buy real estate with your IRA. Super important topic. Real estate's the #1 asset. Crypto's not beating it. Real estate's still #1 for self-directed investors. And we've helped clients do it for years. We've been doing it ourselves. And I'm excited for today's episode to talk about how you can use debt, get a mortgage to buy real estate with an IRA. You might not be able to buy without it, or to buy more properties than you could if you just were buying them all with cash. So we'll be hitting that today. Also hit some alternatives. I got some great questions that came in about what if I don't want to use debt, maybe partner. So I got some questions that already came in that I think are great. We'll be hitting. So Bill and Shelly, you both had some great questions. I'm going to hit yours. Like Aaron said, we'll hit the Q&A function. We're going to go back and forth between sharing slides. So here's the slide deck here. This is going to be saved and will be posted along with the recording. So, you know, you got to run to the bathroom or run your kids somewhere or whatever. You got a better webinar to be on. I don't know.
The best of both worlds, video and slides.
That's right. We got it all for you guys.
We're hooking you up.
And will be recorded. So you'll get access to the slide when the recording gets posted at directedira.com/webinar. And then just give us a few days. We'll get the recording up. You'll be able to get the whole thing.
Sweet.
Okay. You already hit the Q&A stuff.
Yeah.
Let's just, you know, hit the disclaimer.
This is the highlight.
Yeah. And I know Nick's going to have his own disclaimer because, you know, we're a financial institution too, and I'm an attorney. So this is the boring attorney math that has to come out here for a moment. Give a disclaimer. This does not constitute financial advice. It's not constitute an attorney-client privilege. We're just here to give you some educational content. So
it's like a good mullet, you know, it's like business in the front, party in the back. It's like the fun mat, attorney mat.
Yeah.
All the mullets have come back.
Yeah.
Like they're totally in style again.
Yeah, I see like elementary schoolers too. It's like younger kids. I see like the younger kids doing it. But I think like the football players was like OBJ has a mullet basically, doesn't he?
Yeah, and kind of like Patrick Mahomes, like they did the shaved up and
it
looks cool. I mean, listen, there's no hair, so
yeah,
any hair is good.
They can do it. So just a little bit about me, CEO here at Directed IRA, author of the best book on self-directed IRAs, happens to be the #1 selling, the Self-Directed IRA Handbook. Yeah, right here, which has a chapter on how to get a loan, a non-recourse loan with your IRA to buy real estate, amongst some other great topics. I'm a partner at the law firm KQS Lawyers too, and have our Self-Directed IRA Summit, which guys, if you are not going to the Self-Directed IRA Summit, you're not living right. You're not. Next week, Aaron and I are going to be there, okay? Thursday, Friday, Self-Directed IRA Summit. We're doing some tax and legal planning and how retirement accounts fit into it for a couple hours on Thursday. We got a party Thursday night, cocktail reception party, whatever you want to call it. And then Friday, it's full day self-directing from how to partner, use LLCs, get non-recourse loans like today, avoid privileged transactions, structure real estate deals, crypto, all that stuff we're going to be hitting at the Self-Directed IRA Summit. So get over to sdirasummit.com, sdirasummit.com.
We do have tickets like in person, which is cool because we got 2 networking receptions. So if you're looking, you know, to network with other like-minded people, you know, creative deal structuring types of deals they're going into, like get there in person. If you can't, we do have a live stream option as well, but we'd love to see you. We probably got about 15 or 20 spots left last minute. So that's where we're at.
Yeah, and there's a VIP option, which has maybe 5 tickets left.
Yep.
So there's a VIP option with a dinner at the Water Grill, which is an awesome spot right next to the hotel we're going to be at. So that's in Costa Mesa, California, again, next week, April 21st, 22nd. Okay, I also write for Entrepreneur Magazine. I just had a recent article there.
Really good article.
Yeah, the 1099 rules for PayPal, Venmo. Got some other great stuff up there. And then I contributed at Cryptopedia as well. I'll let Aaron tell you about him. He's a good dude. This is Aaron Halderman, the great and powerful Aaron Halderman.
Oh, that's awesome. Well, I love, you know, what we do here, helping people take control of their retirement. As a CEO at Directed IRA, love doing that. Spent a number of years in real estate and notes, so very familiar with those transactions. And, you know, just kicking it here in the good weather in Phoenix. And, you know, we're growing like crazy at Directed IRA, just really empowering people to do cool investments, you know, with their retirement accounts. So let's get it.
Yeah. Okay. let's kind of hit just a couple of important points that I think are kind of like initial points you got to know. And that is, you can use debt to leverage your IRA. So let's say you only have 50 grand in your IRA and you're like, man, I can't, the property I want to buy is 100,000. I can't buy it with just my IRA. What are my options? You could partner with someone. We'll talk about that a little bit through today. You can maybe negotiate some seller finance terms from the seller if you're good at that and know what you're doing and get lucky. Or you can do it the old-fashioned way, go to a bank and get a loan, right? And I've done that. So like my first property that I bought with my retirement account, owned an LLC, LLC bought the first rental I bought, actually used Roger, a colleague of Nick's at First Western Federal Savings Bank, and I got a non-recourse loan. I put down about $40,000 from my retirement account. The bank financed about another $45,000. The property was 85. It was in Indianapolis, still is. I still have it. Property's worth almost 200,000 now. I get 1,300 a month in rent. I bought the thing for 85,000. And so, but this was me starting this at the very beginning. And I was like, even though I was self-directed retirement guy, and I mean, I hadn't written my book yet, but I was like advising clients for years. I still had to get my contributions in and build up enough so I could buy it. And getting the loan helped me get that property sooner, and it's turned out to be an awesome property. Meanwhile, I've of course paid down the debt. I've got the equity that's been growing. My rent's gone up from, I was probably collecting about $900 a month when I first bought it. Now I get $1,300 a month. And so been a lot of good upside, but it took getting that non-recourse loan to pull it off. So we see lots of clients over here. There's a number of other banks that offer these non-recourse loans that you can use. We want to kind of outline that and how it works. So the first thing I want to say, and then I'm going to intro Nick here, and we'll get to his slides, is you can't just get a regular loan. So like if your IRA is going to go buy property, you can't just go and like, can I just go to my buddy, the mortgage broker?
No, I'm ready.
Yeah,
I'm ready.
you know, you can't go into your local bank or credit union and be like, I'm going to use my IRA with my LLC to go buy a rental property, and I need a non-recourse loan. Like if you walk into your bank or credit union,
That's like French.
Yeah.
You're like speaking French. No offense to any people that might be from France, but
it reminds me of John Travolta in the movie A Civil Action is one of my favorite quotes. He's like, it's like Chinese translated into English and back into Chinese again. I can't understand it. You know, that's what the banker's going to be saying there. So you want to work with the bank that knows what this is, that has lenders that have done these, that's done hundreds and thousands of these. And that's why we have Nick here from First Western Federal. They've done a lot of these. So you want to make sure you're working with a bank that knows what the heck it is. You do not want that bank to be creating this loan product for you where they've never done it before. Trust me, I've had clients go down that road. It's a nightmare. And they ended up paying me way too much in attorney's fees. So, okay. Well, we ready for Nick? You have anything else you want to?
no, I think what I just want to make sure, like just kind of setting it up to pre-frame, like kind of what the steps are, the timelines we want to cover for you all that are on here with us and be watching it later. And also like, what is this like, you got a deal ready. There's basically a couple scenarios. You got a deal that you're looking for a deal, or you already have a deal that you've used your IRA to invest in, you're looking for this type of loan. So there's like a couple different scenarios and timelines and what you need to have ready and prepared for in order to like be successful in executing on this. I'd say that's it.
Okay.
We hit on those things.
Love it. We're going to come back. We have some other slides on our side after Nick, because we want to talk about some other things you need to know. But Nick, sorry, we've been talking about you this whole time, but
Welcome.
We'll let you talk now. I'm sorry.
No, thank you. Thank you. All good information.
Okay, well, I'm going to put up your slides here. So this is your disclaimer. I don't know, disclosure.
This is my mullet.
Your mullet. Thank you.
Pay attention,
There was going to be a pop quiz later.
So Nick's executive vice president at First Western Federal Savings Bank, and you're in South Dakota, Nick?
Rapid City, South Dakota. Yes, sir.
All right,
Yeah.
the thriving metropolis of Rapid City. Okay, well, you tell me, you want me to hit the next slide? I'm just gonna drive for you.
Go ahead. Yep.
Okay,
Whoop.
whoa. What happened there?
Well, they turned white.
Okay, 1 second. I'm gonna come back to the screen. Let you just start talking. Why don't you just explain like what you typically do? I'm gonna fix that on the slides while you.
Sure, yeah. Nope. So First Western Federal Savings Bank, we have been lending to self-directed retirement accounts for quite a while now, 12, 13 years now, if not more, but we do. It's become a huge component to our little bank here in South Dakota. We are on Main Street in Rapid City, so we are what a lot of people would consider a community bank, but we also have kind of created a niche in this non-recourse lending arena to, I think we're probably one of the nation's leading non-recourse lenders to self-directed retirement accounts now. I think it's an incredible tool. Obviously, Matt and his team, they spoke about some personal experiences. I too have a self-directed IRA and an LLC and use it for the same purposes and love the product, love the idea. So when you're buying, there you go.
There you go. I'm gonna make it even better. Sorry, this is my work in progress here.
Yeah, no, that's fine.
Feel free, you go where you want. This is your
Yeah.
first slide. We already got your disclosure out of the way.
Yep, the disclosure's gone. So when you're purchasing real estate inside your self-directed retirement account, the IRS requires that if you use leverage, it be non-recourse leverage. And simply, what is a non-recourse loan? The loan is secured solely by the collateral. So in the event of default, the bank can't come after any other assets owned in the retirement account, nor can, we get a judgment against the owner or the account holder of the retirement account. The asset is the only security. And reason being is the retirement account is actually the borrower.
What about like a personal guarantee? Do you let people do that? You make them do that? Can people
No,
do that?
no, there is no personal guarantee. Nothing tied to the natural person is on the loan. Obviously, at time of application, there are some regulations that require us to verify identities and things like that. And so a credit report is pulled on that, but it's not reported to the credit under the person. It's not, the person is not the borrower. Strictly the retirement account is the borrower.
So Nick, answer this question for me. Like, you're looking at the individual's credit. Does that in any way, shape, or form come into play during your underwriting or vetting process? Like, because you're looking at it all, but you're like, oh, well, does that take into any effect at all?
Not for the terms of the loan. Now, if there are a bunch of judgments out there or a bankruptcy or something, just to kind of complete our loan file, we're going to want some justifications and stories behind it. But really, it doesn't change the terms of the loan at all. No.
Okay, very good. That makes sense.
Yep. So being that we're not using the account holder or the IRA owner or the LLC members, I'm going to call them the account holder, who is the benefactor of the retirement account. We're not using their personal income. We're not using them at all to guarantee the loan. These loans are driven by cash flow, and you can maybe advance a slide or two. But anyhow, so cash flow is the key to these non-recourse loans. And amongst other things, we're going to take into consideration. There we go. Okay. So eligible entities, any self-directed retirement account or even health savings accounts are eligible for this type of loan. But I haven't met an entity yet that is a retirement account that we cannot make a loan to. So whether it's a traditional Roth IRA, solo 401k, or as these guys were speaking of earlier, the IRA LLCs, which is probably one of the trending retirement account vehicles and non-recourse loan vehicles at this time.
Right. I mean, that's what I use. And I think that's what most real estate clients use. Even if they have a property manager, is using an IRA LLC. It's just nice, puts you in control, easier to do deals. And you guys don't care. The terms to let your loaning to an IRA LLC or a solo K or directly out of an IRA, same loan terms.
Same loan terms. Yep.
Right.
It doesn't matter.
Okay.
My loan processors actually prefer the IRA LLC just because from the document preparation, it's quite a bit easier. But no, regardless, it's all the same.
Okay. Cool.
We lend, First Western Federal Savings Bank, we lend on 1 to 4 family, multifamily, high-rise condo, vacation rental property, pretty much any residential real estate property. We also do commercial properties, and we do some, not many right now, but we do some ag properties as long as it's an investment property. So it's got to be income producing. We are willing to take a look at it. Some of the underwriting criteria from a property perspective.
Let me ask you this before you get to the underwriting, just in terms of eligible properties. This is like buy and hold stuff, right? Like if I want to flip a property, you're not going to lend on that, right?
No.
A non-recourse lender is like, yeah, maybe a private lender, but a bank is like, yeah, I don't want to lend on a flip.
No, especially in a non-recourse, because you get into it and it's got a bunch of problems and over your head and something you can't do, or something's going to take way more money than you anticipated. I got a loan on it. I'm stuck with a pile of lumber out in wherever.
Yeah.
So no, it does have to be, and realistically, once we put the loan on it, we prefer it to be rent ready or needing less than $10,000, paints, carpets, maybe a new bathroom or something like that. Some minor renovations is okay, but anything more than that is not eligible for the program.
What about mobile home parks?
Ooh, that's a tough one.
Yeah. We get that a lot here. A lot of people are making those kinds of investments with their retirement accounts too, and it's trending a lot in the news as well. A lot of institutional money's been pouring into these mobile home park communities. So what's your take on that?
I'll be honest with you, we don't do many. We have done, but we don't do many. They're just one, they're hard to get out of. So if I have to get out of,
I like trying to be political.
Like slinging you a curveball there, buddy.
Yeah, no, I appreciate it. The conversation is always fun.
Yeah.
The one thing about these loans is obviously you have to put, and we'll get to it in a minute, but a larger down payment than you do if it's just Bob and Shelley getting a loan out there for their personal investment, but if I have to foreclose on the property and we have to take the property back, I'm not in the property management business. The bank is in the lending business, and we're not going to operate the property. So we're going to sell it as soon as we can. And in the pyramid of buyers, mobile home parks, pretty much up there at the top. There's not a lot of borrowers in that pyramid of buyers. But location is key. Obviously, we're gonna, location is, the famous saying, real estate, location, location, location. The desirability of the property. We're gonna, explore crime in the area and different things. But we have 4 different loan programs. So usually we can find something that works for just about everybody. But the types of property that we do lend on, obviously, residential real estate, 1 to 4 family, we lend up to 60% loan to value or loan to purchase price in most states.
Okay.
There are a few states that we don't lend in, but most states up to 60%. Our products are fully amortizing loans. It's a 30-year loan. You can fix it for 30 years, or we have adjustable rate loans that are available for the investor who's not going to hold the loan for 30 years or hold the property for 30 years. Some of them are going to hold it for 3, 4, 5 years. some of them are in that intermediary area of 10 years, they want to hold it. And so they only want to lock the loan and the interest rate for a certain period of time.
Now, vacation rentals or short-term rentals, sometimes people call, I mean, you do those at a lower loan to value, but you still offer a loan product for it.
Yeah, we'll go 50-50 with you on a vacation rental. The only thing is on a vacation rental that a long-term rental, when we do a mortgage on long-term rental, I also get an assignment of leases and rents.
Yeah.
And that's easy to exercise if I have to. On vacation rentals, it's not that easy for me to exercise that if I had to. So that's why we pull it back 10% on the loan to value, but interest rates are the same on the vacation rental program as they are on the long-term.
Okay.
That's a great strategy though, and reasonable.
Yeah.
So tell me on rates, because I think and I know mortgage rates have gone up, if you blinked last month and you haven't looked at mortgage rates, they've gone up, right?
Well, I got a notice today that they breached the 5% mark on a 30-year mortgage today. So
yeah. Okay. All right. So back to I don't know. When I bought my first house, it was 7.25.
Yeah.
So
Which is still good.
I
mean,
know,
even then.
I know, but anyway, the last property I bought was 2.4, or no, it was like 2.375 from, I don't know, it was below 2.5. It was ridiculous. So what should people expect though? Because I think a lot of people kind of see where rates are at. Is the rate a little higher than your typical 30-year, owner occupied?
Definitely, there's no secondary market. Right. Yeah, there's no secondary market for these loans, so they are held in our portfolio.
Mm-hmm.
So the rates, they are not, you may as well not even compare the rates to the conventional real estate mortgage market. One, they don't change like that every day. We price the loans and we price our products as we see fit, but as our cost of funds goes up, obviously our loan rates would follow. But no, they historically, I've always said that the non-recourse loans, for the last 5-6 years, they've been running about 1.5 points higher than the conventional or the consumer real estate market rates.
Which is, if you put it into perspective, like this is I'll just insert my opinion and what I've seen. It's like 1.5 points, like that's pretty, like you're paying more for that, like in private money or partnering with somebody, like they're,
hard money lender is going to charge you way more.
Yeah. So if people are like, oh my gosh, like 1.5 points, like, that's like, just compare what your alternatives are for what that cost of money would be,
Right.
So,
yeah, no, they're very palatable. The programs are investor friendly. The idea is to help everybody grow their IRA investment portfolio through real estate, and if you've done one, most of them want to come back and do another one. And so it works for the investor, works for us.
Okay. So I do know, when I've seen that, like that 1.5, maybe I've seen that with other banks too, so your competitors, so just so people know, that's kind of, that you'll see that across the board if you look at other banks. But all right, but you're also loaning other properties on multifamily and commercial stuff.
Oh yeah. Yep. Multifamily, 5+ residential. Again, I go up to 50% loan to value. If in the event of the default, again, I have to exercise a whole lot of assignment of leases, right? So I'd rather not do that. So at 50%, we'll go in half with you guys or the investors. Again, very competitive interest rates. They are higher than the programs that we just looked at, but not much. Still very, very palatable rates.
What about the tiny homes? Like just taking a step back on the single family, like I've seen a lot of people like buying the dirt. They're putting like 2 or 3 tiny homes on the lot. And we just had that question come in actually, like, what about my tiny home, like development project? I'm like, that's actually a great question. That wasn't around like 10 years ago.
Right. No. Those are, I guess I would, it's unconventional. So I wouldn't call it a 1 to 4 family, I'd probably put it, I'd probably price it more like a multifamily or a commercial property, but more likely there's a loan there. If there's
Sure.
value to the collateral, you know, we like to do it.
Well, they're not cheap. Like these tiny homes that I'm talking about, I've some, like here in where we're at, I see them in Scottsdale, Arizona, and they're like 200 grand. You know,
Yeah.
it's still like a tiny home. Like, man, that's like, it's like 1,200 square feet. Like, that's like a palace for a tiny home.
Right.
Yeah, no.
But they're like putting 2 of them on a lot. Like, you know, if they're allowed to do that with the CCNR. So,
Well, and in the last few years, you know, a lot of, there's been a lot of discussion, a lot of people presenting things with these ADUs
yes,
behind the house or something. And so, yeah, those are all lendable.
cool.
Okay.
It's awesome. Actually.
All right, let's, now you guys have a test though for, right, does this rental pass? I think that'd be the DSCR calculation. To explain what that is, debt service coverage ratio.
Yep.
And walk
Yep.
through it. I'll go back to your slide on this. So this
Yeah.
is where the numbers come out, guys. I hate to tell you, but there's some math here on today's webinar.
There is. But
You don't need a financial calculator, but may need a spreadsheet.
No, it's pretty simple math. And this is coming off of an example that was on my desk the other day when I made the slides. So
Nice.
this is a real deal.
Love it.
Earlier, when I said cash flow is key to these loans, this is what I mean. The debt service coverage ratio, which really equates to your net operating income being above your operating expenses and the debt service.
And what the bank's expecting you to send them every month.
Right, right.
The bank's like, we want to make sure the
We want to get
numbers,
paid
we
too.
want to make sure the numbers work out so we get paid. Seems
Yeah,
fair.
yeah. Again, the property has to support all of its own debt and all of its own operating expenses. We can't rely on the IRA or the
Mhm.
person to do that. So this is how we calculate it. This is a residential house recently that someone purchased, $200,000 house. After the appraisal, market rents came in at $1,650. And so, you know, using simple math, you can see the numbers there. Annual gross income of 19,800. The vacancy expense, you see there's a soft cost. That's not a hard cost, obviously, but we factored in so that, you know, there is going to be some turnover.
Yep.
Annual taxes and the annual insurance come in. Those are the actual figures that we use. And we use a maintenance factor. Again, that factor is depending on the purchase price of the house. It's a percentage of that.
Okay.
And so again, that's a soft cost that your IRA doesn't actually expense, but we just built it into our qualification.
Got it.
This borrower they didn't live in state. The property was 7 states away or whatever. So they're gonna have a property manager manage the property for them at 8% of gross rents. And so that left the net operating income $11,630. They wanted the full maximum loan amount that we could go was 60%, so $120,000. And based on a 30-year amortization at the rate of 2 days ago was 5.5%. So the annual debt service is $8,176. The debt service coverage ratio, the infamous or famous, whatever you want to call it, algorithm is right there. Net operating income divided by the annual debt service. That number, that nut has to be 1.25 or higher to qualify. It's that simple.
Okay.
If it doesn't qualify at a full 60%, we can notch that loan down 59, 58, 57, 55, 50%, whatever we need to do to make that thing qualify where it needs to qualify. So you might just have to put a little bit more of a down payment.
Nick, two quick questions. The HOA and utilities, so those aren't factored in at all, correct?
If the property has them, they are. If the property doesn't have them, obviously they're not.
Okay.
Well, HOA is maybe dependent, but utilities, explain that.
Everybody has
Is
utilities.
that just because the tenant pays that in their lease, or tell me
Yeah, I mean,
Okay.
typically what we see is the tenant covers the utilities. So
Okay.
we don't charge utilities to the investor. They're gonna have that vacancy month, and so it's kind of built into that vacancy factor. Instead of, a vacancy in Phoenix is probably running about 2%. I'm hitting them with a 7% vacancy factor. Somewhere in there is gonna be our pad for them to cover utilities during the vacant months.
And then that maintenance ratio, are you taking into consideration, just like how you're taking in the underwriting location, crime, schools, like all that? Are you taking like how old the house is, like any renovation work that has been done? I'm trying to get full scope here.
Yeah, no.
What that would look like, because like the devil's
That's
in the details with these types of deals.
That's a great question. Great question. The long answer is yes. The short answer is no. When we're
Not what I was looking
qualifying,
for.
yeah.
There's an
Can I-
answer there for everyone, I
Is
guess.
it okay if I speak out of both sides of my mouth? No, new construction, people are saying, geez, you're nailing me for a huge, maintenance factor in the houses. Certificate of occupancy was issued last week. Nobody's ever lived in the house. How am I going to have that much maintenance every year? You're probably not. It's a soft cost. That's something that, myself or Roger on a case by case basis, if it makes sense, we want to do it,
Okay. So there's some room there, is what we're saying.
Yeah, I mean, it's a pretty hard line in the sand, but we've made that exception before. I'll say that.
Tell me, what was the debt service coverage ratio that it was? What was the 1.25?
1.25 to qualify. Yep.
Okay. All right. So that's the test. And I think, and just as I've talked to clients over the years about this, I've been like, if the property doesn't qualify, you might want to look at, what am I buying this property for? Because let's say it doesn't qualify, guys. What that's basically saying is, this isn't meeting the bank's lending requirements where they feel comfortable lending on it from a cash flow standpoint. Now, you may still look at that property and say, I know this was not a great cash flow property, but I think it's going to appreciate. They're not taking that into account, right? You guys are not looking at any appreciation factors. So if your buy on this property is more on like appreciation,
Yeah.
You could say, you know what, maybe I'll ratchet it down to 50% loan to value so I can qualify it. But if it's not an appreciation property, it's a cash flow property, it's not meeting the bank's test, that might be a good indication of, you got a bad deal, you're overbuying, maybe it should be in a different market. I don't know. I think it's just a good little calculation to know anyways.
Oh, definitely.
So, okay, let me get back to your slides, Nick. You got a couple more. Oh, you got one more. Okay.
And then we'll hit some questions. We got some good ones.
You got a couple minutes for questions after Nick?
Yep. Oh, just the mug shots.
Yeah. You're not in orange, so it's all right. So that's Roger next to Nick. He spoke at our summit before and helped a lot of our clients. And you probably have too, Nick. I just know Roger over the years. So
yeah, no, Roger's a good egg.
He's a good dude. Okay, well, let's hit some questions here. Just so you guys know, we're gonna do some just questions with Nick, and we'll let him go. Then we got a couple other items we want to hit, and we'll do some more Q&A on the topic in general.
Cool.
You got any questions for Nick?
Yeah. So what about any international real estate?
No,
Okay.
we do not do that.
Cool. That was an easy one.
You can't buy it with us anyways, unless you use an LLC, and you have to then get to a foreign country. It's a little tricky. We have clients that do own international real estate, but you're gonna end up dealing with a bank in the country where that property is typically, and them to get a non-recourse loan, I don't know. Good luck.
So we do have people, I'd say, they want to know the states exactly that you're in. Do you just list that on your website?
Yeah, and we have a term sheet. We're in all 50 states with the exception of New York.
There you go. Okay. And then when you're doing the DSCR calculation, are you doing any consideration on other income that the IRA is bringing in, or as an individual, or is it just the cash flowing of the property only?
property must qualify on its own merits.
Beautiful. Okay, and let's see. Can I take out a non-recourse loan for a new build with an intent to sell immediately after the build is completed? Do you like doing those?
No, I know. I don't do any construction lending, no fix
we
and
go.
flip lending.
There we go.
We did have a question, because we did a podcast on this recently too. That about basically, I already own a property with my IRA. Can I refinance out and so I can go buy another property?
Yeah, absolutely. In fact, in 2021, most of our transactions were people that paid all cash today. And
Yeah,
they come to us tomorrow to grab that equity back into their IRA or their LLC.
cool. Okay. Are they the same loan terms then, or how does that work in terms of what
Yep.
what can I get back out cash? Because that's, by the way, you guys, if you do that, that cash is going back into your IRA LLC or to your IRA, how you've done it directly or solo, okay, whatever. But it's
Right.
going back to your retirement account or your retirement account's LLC to then go buy another asset. Like, so what's the terms on that? How's that work?
Same exact terms,
Awesome.
same exact term, up to 60% of what you paid yesterday.
It's awesome.
Okay, cool. And you just go get an appraisal at what it's at now.
Correct.
Awesome. Okay, easy enough.
Those are really IRA questions that Matt and I'll hit on. Any triple net QSR deals?
Yeah,
Okay.
Yep.
Awesome. That at 50%, correct?
50%. Yep.
Yep.
That'd be commercial.
That's it. The rest is really for you and I. Oh,
Okay.
is the collateral used for the loan locked in for the life of the loan? That'd be yes.
Yeah, I'm filing a mortgage on that property.
Yeah. Even if you still got like $1,000 left and that's it, that lien's still there.
Yeah.
Just give me the rest of $1,000 then and I'll release it.
Yeah, and then just the calculation of the loan to value, I'm assuming that's just a BPO you're doing or an appraisal, not what you actually paid for it like yesterday.
Well, so we typically order an appraisal
Yeah.
on the property. Now, it's there are certain instances where they already had an appraisal. They were going to buy this thing personally, and they decided to throw it into the retirement account at the last minute. Obviously, being reasonable people, if it makes sense, we do it. We'll use that appraisal.
Okay. Last one, storage facilities, lending on those.
Yep.
All right, there you go, Danny. That was all you.
It's just gotta be income producing, right?
Anything income producing, we're gonna take a long, hard look at, man.
Okay, so the raw land that I don't got agriculture or livestock on, anybody paying me, you don't want that.
Better have some cows or something producing
Yeah.
something.
If it has no way to repay its own debt, I can't make the loan.
Yep.
Awesome.
Okay, cool.
Well, this was very helpful.
Yeah.
Thank you.
Thanks, Nick.
Thanks.
Of course,
Hey.
his contact info is on some of the slides. myiralender.com is the website that you can get to them. And the slides will be up, like I said, in a few days after, along with the recording. Any final words you got, Nick? Anything,
Hey,
words of wisdom?
good luck, everybody.
May the odds be ever in your
Thanks for
favor.
having us.
Thank
Okay.
you.
Thanks for being on, Nick. Appreciate it.
You bet.
All right, I still want to hit a couple other items. So as Nick gets off here, we're going to still talk about UDFI. You guys need to know about that. It's called unrelated debt financed income. Then I also want to go over some alternatives with partnerships, because sometimes clients like to partner rather than get debt. And I want to talk about that. So let's hit that first, actually. If you want to, why don't you go over that example? Let's say rather than me buying a property and going to a bank to get the non-recourse loan, and I'm just thinking about myself with an IRA, but I'm like, I need more money. What are my other options? Like what?
Yeah,
what
probably like the one that we see the most common is finding an individual that wants to do a private money loan with you, and they're going to have their own set of criteria. Now it's still going to be a non-recourse type of loan. Because it has to be, but they typically, it could be it needs to be a not a disqualified person, right? That to qualify for that. So if you have like you can do it even with a brother or sister, or uncle or whatever. But there's lots of people that are like, hey, that will do the money. They may want to charge some points. Maybe they're looking for like 6 to 8%. It's typically a little bit more than the 1.5 that First Western was talking about. They might have some points that they want to add in there.
Yeah.
It's typically, they're not going to do a 30-year term.
Yeah.
They're probably want like a 3 to 5 year term with a balloon.
Yeah.
Like, it's just a little bit different structure because it's like on an individual that's like underwriting the deal, or a smaller company that does these types of deals that's not a bank, and that these are the kind of deals they look for.
And okay, so we got option 1, buy the property outright with cash. Option 2, go get a non-recourse loan from a banker like Nick. Option 3, Aaron just hit, get a private loan. Find somebody who wants to loan, work out deals privately. Option 4, get seller financing. Maybe you can negotiate some creative terms and seller financing. Don't guarantee it.
Absolutely. Don't do that.
Cause that extension of credit privilege transaction. You can't guarantee it. That's an issue. That's why the non-recourse loans are there from the banks. Okay, now Karen asked the question, what about partnering? So let's say Aaron has his IRA and he wants to buy the property, but he doesn't have enough money in his account. Well, he could walk through all those options we already talked about, go to bank, private lender, negotiate seller financing terms. Or let's say he comes to me and he says, hey, you want to go in on this? I got the property's 200,000. I'm throwing in 100. You throw in 100 from your IRA, or even personally, let's go buy it for 200. We could do that.
We high five and we pay for it.
Yeah.
We high five and pay for the deal.
We do an LLC and we get an operating agreement. That's what you're going to need to do with if an IRA involved here.
You're going to use an attorney, a law firm to do that. So there's going to be some expenses there, but you got to do it right.
Yeah, you can partner, and any custodian, us, directed, or someone else. If you're partnering like this, they're going to want an LLC typically, and they're going to want to see, what's going in, and that it's based, the ownership allocation is based on the dollars going in. Now, Karen's question was about partnering, which she also has
herself.
Yeah.
No, you're not doing that. So that'd be a prohibited transaction with your IRA. Can't go partner with you yourself as an individual or one of your entities.
Yeah. Now you could. Now, what some people like to do is, let's say, and this is, I think, where Aaron's going, is basically they'll be like, well, I found the deal.
Yeah.
I don't want to take, half the ownership person of my IRA, buy it. Well, you can't do that. But if you're like, no, I'll cash invest, Karen. So if you're like, no, I'll throw in cash. My IRA is going to throw in cash, and I'll personally throw in cash. Can I partner now? If you do an LLC,
a multi-member IRA LLC. Sweet deal, man.
Yeah. So if I use the multi-member IRA LLC, you can partner. It must be cash. Okay. Or it could be your IRA and your spouse's IRA. So if it's a disqualified person, like yourself, your spouse, your kids, whether it's them individually or their IRAs, if they're going to partner, it's going to be cash based on the cash invested between your IRA and whatever disqualified parties involved. Got to do the multi-member IRA LLC, and then you can pull it up. So Karen, you could do it. Just make sure it's going to be your cash, and we'll allocate the ownership in the law firm if we were doing that at KKO Sawyers based on the ownership percentage between your IRA and your personal funds.
Let me hit one more, and then Matt's going to throw up some slides here. I like your question, Brady. I'm going to tee this up for Matt because we get this a lot. Does an IRA get disqualified if the maintenance expenses exceed the available IRA assets, and I bring in other cash for repairs, or my IRA doesn't have it right, and I gotta figure that out.
Yeah.
Which is why Nick was going over factoring in those maintenance costs and giving a ton of coverage, like 7% occupancy, 8% in maintenance, even though there might not be maintenance. They're buffering.
Yeah, and they have that 25% spread too. They're looking for 1.25 coverage on the debt after thinking of those expenses. So yes, who's that? That's Brady.
Yeah.
So yes, that's a problem. Okay. So what I like to tell clients, even when I do myself, is I want to make sure you have 10% available in an account somewhere else. And some of the banks, Nick didn't go over that. I don't think they have a requirement on this, but I know some of the banks will say, well, it's 30% down, but you got to have a 10% cash set aside in your retirement account. So we'll lend 70-30, but you got to have a 10% set aside. So we know if some expense comes up you can't cover, you can sell some stock, or you got some other cash in your IRA, or it's in your IRA LLC, you could use to cover that. So let's say it's a $200,000 property, they're gonna want to see 20 grand left after you dump your cash in to buy it, that you could sell to come cover any unexpected expense. The AC unit goes out, you got to tenant out for 5 months, you got to evict, whatever, you know. So, so that's the first thing. We want to try and avoid that. Be smart about it. Don't overextend yourself and get in a position where you have to do that. But if you did, there's some options. Okay.
It's in the handbook too.
Yeah,
About
it's in the
that.
handbook.
Yeah.
There's something called Private Transaction Rule, PTE Exemption 80-26, where you can lend your IRA money to cover an expense. This is super complicated. You're going to have to talk to an attorney. Your IRA custodian is going to go bonkers trying to figure this out. You do not want to have to be in this position. If you are, though, okay, if your head's on the guillotine and this is your only option to get out of this thing, you can do it. Okay, but you better be like the last, this is their only recourse. So
You'd be better off finding somebody to like be a private lender to you.
right, that's
Like
what we tell
that's
clients
like
first,
that's the
yeah.
better option. Like
Yeah.
if it was like 5 or 10 grand, just do like a promissory note or
Yeah,
something,
get
you know.
some third party, non-disqualified person to lend your IRA or IRA LLC money. But if you can't, whatever, it's there. Honestly, I've only done it twice. I know we've never done it at directed IRA. I just never had a client that had to do it in the end.
Yeah.
So, so that's PT 80-26. It's in my book if you want to read up on it. Basically, you loan your IRA the money, the IRA then pays the expense. So don't just think, oh, I'll just cut a check to cover that person. That's a private transaction.
Yeah.
The only way this works is if you actually create a document and lend money to your IRA, relying on the exemption, then your IRA custodian has to track that. It's a nightmare, so it can be done. I know that was a long answer. A lot of your custodians just say you can't do it, but I'm telling you it's possible.
End
It's
of
tough.
discussion.
Yeah.
End.
Because they don't want you to. I want to tell it to you straight.
Luis, there are other lenders that do it in New York. If you go to directedira.com, you can go to our learn section and we have a resource directory and we have a few non-recourse lenders in addition to First Western that you can check out there and that, you know, we'll do New York.
Yeah, I think there's 4 or 5 banks we have on that.
There is, yeah.
On that site, and a couple of them don't do New York. That is
Yeah.
one of the states. I know New Jersey, some lenders a little shy on. Some of the other non-recourse lenders have a little different terms on condos versus single family, like
Yeah.
homes, you know, detached, whatever you want to call it.
Danny, I'm going to hit your question as Matt brings up the slide. So, because we get this all the time, I have an LLC already and I want to, you know, can I just use that for, you know, my IRA investment property? No, you cannot. You need to create you do the IRA LLC structure with a new LLC where the IRA is going to be a member of that LLC. So you're not using an existing LLC and be like, well, my IRA is going to be the member of it now. Doesn't work like that. And we're happy to do that. You just go to directedira.com, schedule a 30-minute getting started call. We'll help you with that. And we'll facilitate that with the Matt's law firm at KQS Lawyers. Easy peasy.
Okay. Other thing you want to know. So remember, what I always kind of like to say, there's 2 things you need to know. If you want to get a loan to purchase real estate, mortgage, debt, whatever you want to call it, you want to know 2 things. One, the loan's got to be non-recourse and you're not signing personal guarantees. We already covered that. The second thing you need to know is there's a tax called UDFI, unrelated debt financed income. Now we've got directed IRA podcast episodes on this. There's a chapter in my book, chapter 15 on this, that gets into the details and all the code sections if you want to geek out. It's actually it's easy to read, and I don't want to make you, I'm not trying to talk you out of it. It's just, I got all the stuff there, what I'm saying. I got the backup. But let's just do an easy example, because that's the easiest way to understand this, the tax. Basically what the government's saying with this tax is, hey, you want to go buy a property for 100 grand, but you only got 40, and you want to get a loan for 60, that's cool. But that other 60,000 in this real estate deal, that's not retirement account money. That was debt that just came in to leverage your retirement account. We're going to make you pay tax on the profits on that piece of the deal. And that seems fair, because let's say I was just an individual and I was going to throw in 40 grand for my IRA and 60,000 of personal cash, and we broke up an LLC 40-60. That's how that would work. The IRS is going to make you pay tax on the 60% side that you put in personally, but the 40%, 40,000 from your IRA is going to come to your IRA with no tax. It's the exact same thing they're doing with UDFI tax. So let's say you buy a property for 100 grand and you do what we just talked about. The IRA puts in 40 grand, the bank loans 60. Let's say you make $10,000. When the IRS looks at that, they're going to say, cool, 40% of that deal, representing the 40 grand out of 100, 40% of that deal was the IRA money. So we're going to let 40% of the $10,000 in gain or cash flow go to your IRA. Don't worry about tax. This other 60% though, that was not retirement account dollars.
Yeah.
That was debt. We'd like to tax that. Okay. And this is where that UDFI tax comes in. So if you had 90% debt on it, and this changes, this number adjusts every year based on the percent of debt you have on the property. So hopefully it goes down over time. You're paying the loan down, but let's just stick with the 60%. So have the 10,000 gain, 60% of it was debt, 6,000 of that gain is subject to tax. Now, what you get when you sell a property is you do get the capital gains rate of 20%. 20% of 6,000, $1,200. So cool. I paid $1,200, but I was able to buy a $100,000 property.
Just pretty sweet.
Yeah, rather than a $40,000 property I maybe couldn't have bought. Or I bought 2 or 3 properties when I could have only just bought one with cash. So I know no one loves tax, but when you run the numbers and you calculate it down, it's only on the debt piece, which is an example was 60%. And then on the gain, you're only paying capital gains rate, which is 20% of that. It ends up being maybe a 10 to 15% overall tax. And remember, you're going to pay the debt down over time. So that debt ratio is likely going down. Now, this tax applies on the cash flow too, if you have it year to year.
So that rental income.
Yes, that rental income. Now, a lot of clients on rentals don't ever have to worry about it year to year, even if the property's cash flowing, which it usually is, because they have a depreciation expense they get to take off of it. So that depreciation expense usually offsets the cash flow, and then you don't have UDFI. But where we do see clients run into this is when they sell. The property's appreciated, they've still got debt on it, they sell it and have a gain, and they got taxed. But remember, it's only on the debt piece, and on the time of sale, you do get the capital gains rate of 20% instead of your regular rates. Now, a couple quick tips on this. First, one strategy I've done with a lot of clients over the years is pay the loan down, hold it 12 months with no debt, and then sell. When the IRS looks for UDFI tax, they only make you look at debt and calculate the debt. They make you calculate the average debt 12 months before the sale. So if you held the property for 12 months with 0 debt and then you sold it, you only have to look back prior 12-month window. What was the percent of debt? 0. No UDFI tax at the time of sale.
Brilliant strategy.
Yeah.
Awesome.
So a couple of things on that. One, apply your cash flow to pay down the debt. If you plan on selling the property, once debt's paid off, hold it a year with no debt. Another one I've had clients do is that had a large loan balance and there's no way the cash flow is going to offset it for years, but they still want to sell in a relatively short time, is have a partner come in, get someone to JV on it, buy into your LLC, and use that cash to pay off the debt and give them an equity percentage of the deal. Maybe give them 3% or 5% or whatever. That's going to be cheaper than paying the tax on the UDFI. And so I've had a number of large clients use that strategy where they can go grab a private investor friend of theirs. They're like, sure, I'll come in for 12 months, give you the cash to pay off the debt, but give me a piece of the profits when you sell this thing, and I'll just basically be a partner. Now I've got out of UDFI too.
It's cool when that partner has a Roth IRA too.
Yeah.
To come in and do that deal if they can.
That's a win-win for both of you.
That's even better when we get into like turbocharging a Roth IRA.
Yeah. Yeah.
Which is
I like
cool.
to say supercharge. You say turbocharge.
I do turbo.
Aaron likes the word turbo.
I do.
He refers to certain people as turbo.
Oh gosh.
Okay, so let's hit a couple other tips on UDFI. Another one, solo Ks are exempt from UDFI only on leveraged real property. This is a commonly misunderstood exception. In fact,
UDFI exempt.
No.
Oh, it's not.
It's funny. I was looking at a competitor's website who was touting how crafty they are with their clients. And they're like, we had a client that wanted to buy equipment. They were in the equipment leasing business. They wanted to buy equipment with their IRA. And we told them, don't do that. Use a solo K, buy that equipment with your solo K because it doesn't pay UBIT or UDFI.
That's incorrect.
I was like, yeah, you screwed them up. Okay, that equipment is personal property. It's not real property, and they still owe it. And I'm almost like, why have you saw that on your website? Oh my gosh. But they still haven't figured it out apparently. So this UDFI exemption is specific to leveraged real property. Okay. So if I'm using debt to buy equipment or whatever with my solo K, that exemption to get out of UDFI, specific to solo Ks or any 401k employer plan, it's only applicable on leveraged real property. Okay, so that's a cool one though. A lot of you that you have the solo K
And
buying real
great
estate.
clarification.
Yeah.
Because it does get messed up all the time.
I know. I'll be like, well, I'm flipping properties, but I'm doing my solo K, so I don't pay you. But no,
Yeah.
someone twisted that up for you. Sorry. Woo. Okay. Were we gonna hit anything else? Do we have any good Q&A? Where are we
Well, we
at?
hit most of it as just we peppered talking and I'll just be like answer live and we're doing it right now. Did it. But Tracy, I want to buy and hold land. If I use my IRA, can I later build on this land or have a family member buy and build?
What was
Okay.
that one? Do you want to-
So that would be a prohibited transaction if they, if it's a direct family member and deemed a disqualified person. So like my IRA buys land and now I'm gonna like go build some spec homes on there. My family member is gonna go buy it.
Yeah, we want to know who in the family. If it's like your spouse or your kids, it's a problem. If it's your brother, cool.
An uncle.
Yeah, they're not disqualified. So you want to get to who's disqualified or not. We got a whole webinar on privileged transactions. You want to check that out.
And maybe Uncle
4
Rico
chapters
buys
in my
them
book.
all.
Yeah.
Maybe Uncle Rico buys them all. That's Napoleon Dynamite for those of you that don't know.
Yeah, Uncle
Everybody's got an
Rico.
Uncle Rico.
Legit. He could.
He buys the whole development.
Your
Problem
IRA,
solved.
your IRA could partner with Uncle Rico if you want. Okay, let me hit a couple of the questions that came in. Bill had asked a question about buying a vacant lot that you intend to buy, build a single family property on. That will cost about 400 grand, has about 200,000 in the IRA to do it. Can I get a non-recourse loan to do this? No, and Nick talked about this with First Western. They generally don't like to do construction loans, and I actually do not know any of the non-recourse lenders that are banks that do those. So you would need a private lender, or maybe look for someone that wants to partner in on that deal. That's probably the best way to pull that off, Bill. Unfortunately, just because of the non-recourse nature in those loans, the banks are really gun shy to do a construction project. Shelley asked about pros and cons between using debt versus having a partner. I think on the pro side, a partner's easier if I'm using my IRA because I don't need to worry about UDFI.
Can close quicker too, typically.
Yeah, sometimes.
You
Yeah.
can usually close
Depends on the
underwritings.
partner.
Yeah,
you
it's
have.
true.
Some, that's your pain in the butt,
Pain in the butt partner could be like
golf
3
friend
months.
or whatever, or yoga friend or whatever, choose your partners wisely. But
We know Matt's activities now, golf and yoga.
I was just trying to get the guys and the ladies, I was just trying to get everyone. So on the plus side with debt is you get all the upside. If there's a lot of appreciation in the property, you get all the upside on it. And so I'd rather have the bank who I just got to pay a fixed amount back to, where a partner, I had to split up the profits. So I don't love that. Also a partner, and this is the one thing, I have real estate I own with a partner, with Mark, and I have real estate I own separate from him. And this is not about Mark, by the way, I should say this. Sometimes it's easier to just control your own destiny and have your own thing, right? You don't have to worry, do I need to sell it? Maybe I need to sell it because I need to get cash out, but I've had a partner in it. They might not want to sell, or maybe I have a better deal I want to do and I need to get out of this and get the equity out of this to do this better deal. But my partner's like, whatever, I don't want to get out of this and I don't have the money to buy you out. Sometimes partners, can tie you up a little bit. So be careful on that. I've just seen that over the years. Clients have issues of partner doesn't want to sell, they do, and how do they work through that? And sometimes it can just become an issue. Whereas if you just have the bank's like, it's cool, sell. You're paying us back either, you're paying us back. So we what do we care? Okay, Shelley also asked about what to look for when using a non-recourse lender and comparing lenders. The first thing I'll say is make sure you're using a non-recourse lender, a bank that has done these before. I said at the front, right?
It'll say that too, like
Yeah.
that they are doing non-recourse loans. Like
Yeah.
it says that specifically.
And all the ones on our site, on our,
A directed IRA
yeah.
and our resource directory.
Resource directory, that's what it was. That's what I was looking for. I know our company name. I just forget them.
Or just fill it in the blanks here, you know?
Where do we work? No. There, you know, we've had clients use them successfully. We can't like vouch for them or anything, but you know, we've had clients use them, and you know, I've used some of them too. So, and then, but also when comparing even those lenders or just any other non-recourse lender you might find, it just comes down to terms. Like some of them will take 25% down, but they might have a little higher rate. Some of them won't lend in certain markets. Some of them lend differently on multifamily and commercial versus what, you know, another bank does and how in their loan to value ratios. So all of them kind of a little different flavor of how they like to do it. So just shop around like any bank, you know, and just see what your options are in terms of terms.
Yeah. Typically, those departments aren't really big either.
Yeah.
Like this is if you know, anybody's in financial services at all, like this is a very niche product, if you will, that's like a carve out of, you know, what the bigger products and loans that the banks do. So it's just like they have a smaller team. They're like Roger and Nick, and you know, they're looking at the deals themselves.
Yeah, they're the ones that
You
go
know?
get it approved. So like you're talking to the guy that
Yeah.
like says we can do this loan sometimes.
So they have an underwriting team, but they are the ones that have oversight management, because remember, they're keeping these loans in-house at their bank. So they're not funneling those up and selling them on the secondary market because there's not a secondary market for them. So that's what those look like. So it's a pretty cool product. Like, you know, it can really, you know, get you more assets too with, you know, leveraging a retirement account. It's pretty awesome. Speaking of retirement accounts, you can get $50 off by going to directedira.com. You fill out an application, and, you know, and ready to get going. You get $50 off using the promo code webinar50. Rock and roll.
Yeah. I've been sharing that up there for a while. Sorry, guys, I forgot. But thanks for being on. This is recorded. If you want to come back, you missed certain parts, you want to share it with, you know, your loved ones. And if you hated it, I guess you could share it with your enemies. But if it was painful, I hope it wasn't.
Yeah.
And we'll get the slides up too. And make sure you're following the newsletter. So get signed up for it at directedira.com. Make sure you're following that. You'll get updates on the podcast we do every week, on the webinars that are coming up, on the Self-Directed IRA Summit that's coming up.
We do a couple of those too.
Yeah.
So like go to sdrasummit.com, check that out. We do it twice a year. We got another one in the fall in October, which will be in Arizona. So we have a charity golf tournament too scheduled for that one, which was awesome last year doing it. It was sold out. So it's awesome networking opportunities. So always looking to give you great education. And if you love today, my name's Aaron Halderman. If you hated it, I'm Matt Sorensen. But we love doing these and love talking to all of you. And it's awesome.
Yeah, thanks, guys. We'll be back next month. We haven't got the topic ironed out. That's why I say sign up for the newsletter. We'll have our crap together and we'll announce it in the newsletter. And until then, stay calm and self-direct on. Thanks, everyone.